back, everybody, to another episode of the Nonprofit Show. We're really excited to have Steve M. Sliwinski here with us today. We're going to be talking about something pretty heavy duty, and that is nonprofit investments, how to manage them, what they are. Steve, I look to you as being the oracle of all things investing today. Thank you.
Well, thanks, Julia.
I'm thrilled that you're going to be here, and I think you're going to unravel some mysteries for us and really paint some new pictures for us in the nonprofit sector. And this is an exciting time to get this type of information. You know, it's also exciting are the amazing partners we have that support the Nonprofit Show. We've now done more than 1,300 episodes. We're in our 6th year. And it's all due to our sponsors. They include Bloomerang, American Nonprofit Academy, Staffing Boutique, JMT Consulting, Nonprofit Thought Leader, Third Sector, Your Part-Time Controller, and Fundraisers Friday. I'm Julia C. Patrick, CEO of the American Nonprofit Academy, joined today by Steve M. Sliwinski, CFA, CAIA, Chief Investment Officer of Christian Brothers Services. Okay, let's back the bus up, Steve, and have you explain to us what your professional designations are. Because, well, that's the starting point.
Sure, Julia. So first, thanks for having me. It's great to be with you and your viewers. The CFA and CAIA designations are two professional designations in the investment industry. Chartered Financial Analyst designation. It's a few-year program similar to the CPA designation, and then the CAIA or the CAIA is specific to alternative investments. Similar structure, a couple of tests, self-study programs. Got those a while back, but they were a great experience.
I bet. Okay, so now let's back the bus up even further and talk about Christian Brothers Services, because I think you have a fascinating organizational story and history that has led you into modern times in managing investments and tools for nonprofits. Talk to us about your origination story.
Sure. So Christian Brothers Services was founded by Brother Joel Damien in the early 60s. And, you know, the Christian Brothers, the LaSallian Christian Brothers, as a religious organization, have the mission of teaching and educating, particularly the poor, but throughout the globe, they're a teaching religious order. A couple of brothers that were running Catholic high schools here in Chicago, Christian Brothers schools, were looking to purchase student accident insurance for their students. A couple of them got together and said, instead of buying two separate policies, why don't we pool our resources together and use that purchasing power to buy, one policy. From there, it grew into the retirement space. Again, a similar story in that instead of creating two pension plans for their teachers, let's create one multiple employer pension fund. And it grew from there. And now we serve, thousands of Catholic institutions around the country in retirement, health, risk, and consulting.
Wow. So like LaSalle University and that institution by that order is really what kicked this all off.
That is correct. Yes, the Christian Brothers is a mission or education focused and oriented. We're one of the two organizations that Brothers created to help support that mission.
Amazing! What an interesting story, and I love the story of collaboration, because that's a theme that is woefully lacking oftentimes in the nonprofit sector, and yet funders are pushing this more and more. More and more collaborative calls on grants and funding, and so in philanthropic investment. So I love this story. I think it's absolutely fascinating. Okay, so we jump forward. We talk about how you all were started. Really, necessity being the mother of invention. Your group comes together, but let's back up, or I should say, let's move forward and talk about where funds can originate from, because we were talking in the green room. I think a lot of us in the nonprofit sector feel like we've got to wait for one big check to come in or some crazy windfall, and then we have funds to invest. But I don't think that's really the case, nor is it a good strategy. So set us straight. Where should we look to be getting these funds for investment to start?
Yeah, I think, it varies a lot, like you alluded to, based on the type of institution. Many endowments and foundations start with that one big check contribution donation. That makes up a big part, at least of the mega institutional investment space and nonprofits. In our space, it's a little bit different. When we're managing a defined benefit pension plan, employers of, say, Catholic school teachers are making contributions, small contributions, every 2 weeks, every pay period for an entire career for an individual. And those contributions then add up and become plan assets, and then get to be, a sizable amount of assets in order to support those benefit claims into the future for that person's full retirement.
Mm-hmm. It's interesting because I can imagine that for those organizations that have this set up, they think about it once and then they're like, we're set up, now we just have to work it. Versus if you are an organization looking to start it up, it's got to be pretty daunting.
Yeah, I think that's absolutely right.
Yeah, really, really interesting. Well, now that we kind of have set the stage for that, let's talk about how much money it should take. And I ask you this question, Steve, because I feel like this can be a strategic, something that's on an organization's strategic plan. Certainly in the case of staff, retention and cultivation, it's really an important part of the whole process. What would you tell a new organization or an organization that hasn't even really ventured into this?
Yeah, I think the industry has changed a lot over the last 2 or 3 decades, and that you or I or any individual can open up a very low cost brokerage account online or what have you with any of the blue chip organizations like Fidelity, Vanguard, and there's a whole bunch others, and invest in capital markets in a very, very low cost manner. You don't need tens of millions of dollars to do that, and the individual could do it with a few $1,000s, or an institution with, under $100,000. It's certainly not out of reach to create a very well diversified portfolio at a very low cost, very similar to how a lot of really big institutional investors allocate their assets.
Mm-hmm. I love that you mentioned that because it just makes it so much more attainable and something you can put on a goal list or a goal sheet or something that doesn't seem so perilous, right?
Yeah, that's right. It's pretty painless.
Yeah, really, really interesting. So now that you've kind of like given us the structure to navigate this, what we can start with, what we might have, let's talk a little bit about sometimes the elephant in the room, and that's investment committees. How do they function? And I can tell you, as doing board service pretty much all my adult life, the investment committee was always kind of, you were afraid of them, right? They kind of were like secretive, and yet they would tell you good things, or they would be like, wah, wah.
Yeah.
Talk to us about this.
Yeah. So prior to joining Christian Brothers Services, I was in the investment consulting world at a firm called Ennis Knupp and Associates, which then became Hewitt and Aon. And I mentioned that because I used to work with clients at the time, and all different sorts of investment committees and boards. So I've had a chance to see a lot of investment committees, how they work, what works well, what doesn't. And I would say first, for an organization to think about the types of folks that would be a good fit on an investment committee. I think the knee-jerk reaction is often to find, anyone with investment experience, who's the local investment guy. And I don't think that's necessarily always needed. I think kind of similar to the boards of many of your nonprofit listeners, the best investment committee members are focused on high-level strategy, here it just happens to apply to investment strategy, but really having that long-term orientation, that big picture is what makes, I think, a great investment committee member. Investment committees can be subsets of a broader board of directors. It could be independent. Every institution is a little bit different. But if I were to start there, I'd say those are the types of committee members, types of individuals that make best committee members.
Mm-hmm. Do you feel like they need to all be seated on the board, or that you mentioned use the word subset, that they can just strictly be committee members with board representation, or maybe not board representation? What are your thoughts on that?
Yeah, I think every organization is a little bit different. It certainly doesn't have to be that way. I think it's definitely helpful to have some connection between the board and the investment committee, but not all investment committee members necessarily need to be part of the board. A lot of times those skill sets are similar, but they're different as well. So I think as long as there's a good connection, I've seen both ways work pretty well.
Yeah, it's it's a fascinating thing, because I feel like there's so much fear involved in it, and it's high level capacity and leadership, and you've got to be able to have people that will ask questions, that will be thoughtful, will think outside of their tenure, like that old 10-10-10 rule. How do these decisions impact our organization?
Mm-hmm.
10 weeks, 10 months, 10 years, things of that nature. And I've got to believe it's somewhat hard to find those people. What do you think?
Yeah, I mean, it can be. I think to the extent that an organization has a lot of turnover, that can be a headwind. In my experience, the best investment committees have some longevity and have some historical framework on the way things were done. Because in the investment space, the institutional investment space, the long-term strategy is what's most important. It really doesn't matter in the long-term picture what happens next week, last month, tariffs, this, that. Like, it's really the long-term orientation. What's going to happen over the next 10 years? What happened over the last 10 years? And how do we position our portfolio or organization to be in the best position to succeed from that? So in a situation where committee members are turning over every couple of years, it's hard to have that long-term strategy ingrained. There might be an investment policy statement, which we can talk about, that sets that strategy. But without those folks who have been around, knowing why the strategy was set the way it was, that could be a challenge for organizations for sure.
So let's dig into that a little bit. So one thing you said is, like, I'm thinking of organizational history and all that. What is a good size number for that committee? Should it be like 3 people, 10 people, 20? Like, what do you see as a manageable number?
Yeah, I think generally speaking, my experience is smaller is better than mega committees.
Okay.
Having a committee of 10, 20 people, that just gets to be challenging. And for everyone's voice to be heard, generally speaking, an odd number is preferred to the extent there are votes and ties and what have you. 3 to 7 is probably what I think is a sweet spot for an investment committee. I've heard people joke that needs to be odd and 3's too many. I'm not there. But I think 5 is probably a great number. 3 to 5 to 7.
Okay. And then let's talk about, the policy issue, because that has been politicized, what you will invest in, what you won't, how does it align to your mission, things of that nature. Could you speak about that a little bit for us?
Sure. So setting policy is probably the most important part of an investment committee or a board's function when it comes to strategy. It's determining, what should the allocation of assets be? What objective is trying to be accomplished with the assets? Working maybe with a consultant or some outside partner, figuring out how much to invest in stocks and bonds, and having parameters around, what are permissible ranges for those different asset classes. Because, when things get the scariest, think of, during the pandemic when markets were down a lot, early April, markets were down a lot. That's where it's difficult to have that objectivity, and having a game plan in place in advance is critically important. So setting that policy, not just the asset allocation, but how it fits with an organization's mission, how it fits with things like spending policies and whatever other characteristics are relevant to that organization. Those are very very crucial. And then kind of going forward, sticking to that policy and seeing how, if there's an investment staff is implementing that policy, maybe it's much more simple in that there's a CFO investing in or allocating assets to index funds. That's perfectly a great strategy as well. But it's developing that strategy and monitoring and sticking with that strategy over time. That's really important.
Do you see a sticking point for a lot of organizations declaring that they're not going to invest in certain businesses? I'm thinking of, it used to be called the sin businesses, alcohol and tobacco. Do you see that factoring in anymore, or are investment committees a little less concerned about that?
No, I think it's still very relevant. Certainly us as a Catholic institution, it's relevant to us and our board members and constituents, probably a little bit of a broader segment than that. And the marketplace has adapted to that. So it's no longer the only option to invest in, stocks as a fund that includes those, SEN companies or what have you. There are screened funds out there that are, reasonably low priced, unlike maybe 20 years ago where they were all quite expensive. So there are solutions for different types of organizations, big and small, to help implement that.
And that's going to be defined in your policy, correct? I mean, that's something you do up front so that everybody's on the same page.
It absolutely should be part of the policy. Yes.
Okay, interesting. If you're an organization getting started, how do you develop this policy? Should your investment advisor help structure that up, or is this just something you Google or you put it on chat and GPT and hope that you come up with something? Like, where do we originate this home?
Yeah, I haven't tried the chat GPT. It could probably do a pretty good job. Generally speaking, working with a partner like a consultant, it would be a great place to start. There are a lot of great independent investment consultants out there that work with large and small institutions. Even some of the big banks like Northern Trust here in town has a team dedicated to helping institutions kind of get up and get started. I mentioned Fidelity, Vanguard. Really, a lot of these large organizations have built the infrastructure to help facilitate those types of things for smaller organizations just starting out.
Yeah, I love that you mentioned that, because I think that might be somewhat of a surprise to an organization trying to get this ball rolling, that you're like, oh wait, we got to start with this foundational document and understanding. Like, I love that you said, just because you have this document as a foundation doesn't mean you have to keep going back and reviewing it, maybe even modifying it, but certainly understanding how it's going to guide you. Because it sounds to me like it's a pretty strong guide.
Yeah, it certainly should be. It should be, especially when times are tough. That's when the policy should be followed and not be changed. It'd be very easy to look at difficult environments and say, hey, we should react to be more conservative or what have you. You set the policy at the beginning, wide eyes open. This is what we're trying to accomplish over the long term, and abiding by that, especially during the difficult times, is incredibly important.
So let me ask you before we go on this, because this just kind of came into my mind as a question. How often do these policies, how often are they changed, or should they pretty much be consistent? Like, what do you see on that front?
Yeah, I think absent kind of material changes to the organization's situation, 3 to 5 years would be typical. But to the extent an organization gets, a large donation in, or circumstance of change in some other regard, that would be a natural time to revisit the strategy as well.
Interesting. Well, that's a great kind of lens to look through, because I wasn't sure what you were going to say. I was like, what, where is this going to be on the spectrum? Because again, it's going to take some educated, dedicated committee members, and then throwing that back up to the board to get that review done, right? I mean, it's not just a quick thing. I mean, it's going to be something that you need to put some thought into.
Yeah, that's right. And that's another reason why, longevity and historical knowledge is important for committee members and board members as well, to remember that process of setting policy.
Yeah, really interesting. Okay, as we kind of finish up, this time has like gone by so quickly. Talk to us about benchmarking. I mean, we do this in programming. We do this in the census of who we serve. We do this with our staff and labor and fundraising. But how do we do this for investments?
Yeah, that's a great question. And it's a really important part of the overall governance process for an institution. I think first and foremost, every institution should have what I would call a policy benchmark. A policy benchmark would be made up of, investable asset classes, generally like a 60-40 split between stocks and bonds, 70-30 depending on your organization's risk tolerance and risk profile that you'd go through in that policy setting process that we've talked about. So like an appropriate policy benchmark would be something like, 70% global stocks, or the MSCI All Country World Index, and 30% bonds, something like that. That really helps a board and an investment committee measure the effectiveness of the implemented investment policy. There could be a lot of gaming that goes on with benchmarking, but it's important to have a benchmark that's, specified in advance, that matches the risk posture of an organization and is investable, among other criteria.
And so that is done how often? Every year? Like, when does that information go back to the board, or just to the committee and the board, and then C-suite, obviously? But what does that time frame look like?
Yeah, so it's part of the policy setting process that would be helping define what the benchmark is for the pool of assets. And then that's something that would be evaluated at regular investment committee meetings, whether they're quarterly, semi-annually, what have you, and reported to the board kind of in that same cadence. Now, I would say that even though the investment committee meetings may be quarterly, semi-annual, what have you, the purpose of those should be not just to look at the last quarter's performance. It should be kind of aligning with the long-term focus of the strategy and seeing how things have done over a long period of time.
So given that, what do those timeframes look like? Are you taking measurements of, 1 year, 5 year, 10 year, 30 years? And what I realize this is predicated upon the length of your investment tenure, right? But what should we be looking at for that arc of information?
Yeah, I think generally speaking, longer is probably better to the extent that history is available. Looking at things over a 5 or 10 year period is a lot better than having a sole focus on what's happened over the last quarter or year. Generally, over a 10-year period, you get through a full economic cycle that you really get a feeling for all different kinds of markets, and that should give you a good sense of how the investment program is doing.
Interesting. This is somewhat of a personal question for me. Years ago, serving on a board, we had an investment committee, and we had somebody that was not on the investment committee disagree with what the committee was proposing and how they had managed. And I think several of my fellow board members felt that this individual was kind of trying to pitch their own thing. And I wanted to talk to you a little bit about that COI policy, conflict of interest. Like, how should we look at this so that we're protecting the organization from even the appearance of something that might not be so so good.
Yeah, I mean, I think you hit it on the head. Conflict of interest policy is in having annual affirmations from committee members or
Right.
boards. There are a lot of conflicts, in the investment industry.
Yeah.
I think it's gotten a lot better over the last couple of decades, but nothing's perfect. And knowing the various positions of board members and committee members is helpful, whether it's the policies or just looking at backgrounds or what have you. But it's definitely very, very relevant.
Are you finding that in the last few minutes that we have, there's so many changes abounding with cryptocurrency, with the transference, and we talked about this earlier and also in the green room, this amazing wealth transference. We're seeing estates transfer over real estate, artwork, intellectual property. I mean, all sorts of things. Is it a new time for investment committees to understand these additional investment avenues, or do you think we're staying the course?
Yeah, I think the landscape is always evolving. If you went back 40 years ago, it was just U.S. stocks, U.S. bonds. Then it became broader to global stocks, and then other alternative asset classes like real estate, hedge funds, private equity. I don't know where organizations are on crypto specifically, but I would expect things to continue to evolve over time with new asset classes, strategies. Some may stick, some may be fads. They're certainly not needed to be part of a great investment program. You can do that with just a couple of very low cost index funds, through one of the organizations I mentioned, and get exposure to thousands and thousands of publicly traded companies and bonds, at essentially a free cost or a cost of a few basis points, a few 100ths of a percentage point. So yeah, I mean, it'll continue to evolve. Certainly has during my career, and I'd expect it to continue to change in the decade to come.
Yeah. It's interesting because I would imagine most well, I shouldn't say investment committees, but maybe boards um, think that this is just like a strategic thing that you do and it's the same, and that it doesn't have these changes other than market value. So it's interesting to hear you talk about that because, you know, uh, intellectual property transfers is really becoming more and more of a popular asset. And there's there's some really remarkable things, isn't it? Irving Berlin's White Christmas, those royalties go to the Boy Scouts of America, right? I mean,
Yeah, that's great.
there's wacky things like that that abound that ultimately are going to get wrapped up into some of these decisions.
Yeah, that's right. There's certainly no lack of uniquenesses, in the investment world.
Yeah, it's really interesting. Well, you have been a unique guest, Steve Sliwinski, Chief Investment Officer, Christian Brothers Services. A great story of an organization that found some needs and then had to figure out how to achieve, what they were trying to do. And so if you go to cbservices.org, you can read about the history of the LaSalle order and what they did and how they've grown this aspect of their business. It's absolutely fascinating and a great story. And Steve, this was really fun. I think for me, you made it a lot more achievable, right? And not something that you have to be like a super sized institution, that you can start small and grow it out.
Yeah, the investment world can be really complex. It can be really simple as well. Not every institution needs to kind of go after the Yale model of managing endowment.
Yeah.
Simple can be a great solution as well, and will probably do better than the average bear over a long period of time. So it's been great being on here. Thanks for having me, Julia.
Oh my gosh, it's really been fun. I've learned a lot, and I think that you've like kind of calmed my fears down. Like I said, I can think of God over the decades when the investment committee was up. You'd always be like, oh, when they had to give their reports, what are they going to say? And yeah, so I really appreciate you coming on, Steve, and chatting us through this. I also want to say thank you to our amazing presenting sponsors. They include Bloomerang, American nonprofit Academy, Staffing Boutique, Nonprofit Thought Leader, JMT Consulting, Third Sector Company, Interim Executive Academy, Your Part-Time Controller, and then Fundraisers Friday. Hey, everybody, we end each and every episode of the Nonprofit Show with this mantra. And today I'm thinking about economic wealth. And the message is this: to stay well so you can do well. We'll see you again.